All right, let's jump right into this explainer and build out your mental filing cabinet for the LECPA. If you're a BS accountancy student right now, maybe you're in your second or third year, you know the absolute struggle. Studying Philippine taxation feels literally like trying to drink from a fire hose while balancing spreadsheets in your sleep. You don't just need to memorize this stuff for tomorrow's quiz, you need a legit study hack to lock these high-yield tax rules into your long-term memory for the board exam, which is like 3 whole years down the line. So today, we're stripping away all the clutter. We're focusing purely on how your brain processes, organizes, and actually retrieves this crazy complex tax code. To beat that exam stress, we're going to systematically open 5 drawers in your mental filing cabinet today. We've got estates and trusts basics, deductions and consolidation rules, proprietary schools and hospitals, tax-exempt educational institutions, and finally, statutory exemptions and BMBs. We are organizing the chaos into super clean, retrievable chunks. Let's get to it. Opening up Drawer 1, Estates and Trusts Basics. Let's establish exactly when an estate or a trust becomes its own completely separate taxable entity. Now, what's really cool here is the contrast. Anchoring the rule to the keyword judicial instantly tells your brain whether the estate pays the tax or the heirs do. Think about it. If the settlement is judicial, meaning it's all tangled up in the court system, testamentary or intestate, the estate itself is a separate taxpayer. The fiduciary, like the administrator, files the return. But if it's an extrajudicial settlement, where the heirs just kind of divided among themselves outside of court, the estate is not a separate entity. The heirs just include their distributive share in their own personal returns. Easy. It's a similar vibe for trusts, but here, your memory trigger is the action word. If the fiduciary hoards or accumulates the money for unborn, unascertained, or contingent persons, the trust pays the tax as a separate entity. But if the money actually flows to the beneficiary, if it's currently distributed, well, the tax burden flows right along with it. The beneficiary pays the tax. It's really all about who physically has the income sitting in their hands. Okay, quick active recall moment. Who pays the tax when an estate is settled extrajudicially? Pause for a second, actually force your brain to retrieve this from your newly formed mental schema before I give you the answer. Got it? Since it's outside the courts, the heirs themselves pay the tax on their share. Moving right along to Drawer 2, Deductions and Consolidation Rules. Let's look at the special mathematical deductions and the rules for when a grantor gets a little too creative. So, the crucial thing to understand here is that this mechanism prevents double taxation. It's brilliant, really. If the estate or trust distributes the income, it acts as a special item of deduction for them, and simultaneously, it becomes a special item of income to the heir or beneficiary. It just seamlessly transfers the tax liability straight from the trust directly into the hands of the beneficiary. Now, I need you to burn this massive number into your visual memory. 15%. Any income distributed to beneficiaries is subject to a 15% creditable withholding tax. Seriously, when you see the phrase income distribution from an estate or trust on the LECPA, your brain should immediately flash a giant, glowing 15% sign. And this next part brilliantly illustrates the BIR's countermeasure against tax avoidance. Let's say a grantor gets sneaky and sets up multiple trusts for the exact same beneficiary to abuse the lower tax brackets. Yeah, the BIR isn't having that. First, you identify the triggers, same grantor and same beneficiary. If you hit those, you must collapse them into one single computation. You consolidate the taxable income of all those trusts, compute one consolidated income tax, and then finally apportion that tax to each trust based on their share of the total income. It's basically a giant anti-loophole equation. Slamming that drawer shut and opening up Drawer 3, Proprietary Schools and Hospitals. Let's talk about some special corporate taxpayers. Let's look at these preferential corporate rates. They are basically your immediate LCPA cheat sheet. We're looking at private nonprofit hospitals and proprietary educational institutions, or PEIs. Now, normally, regular corporations pay 20 or 25%, but these guys, they get a really nice preferential 10% rate on their net income. And you absolutely must pay close attention to historical dates on your exam problems. Between July 1st, 2020 and June 30th, 2023, they enjoyed a super low, highly testable 1% transitory rate. But hold on, they don't just get that sweet 10% rate automatically. They have to earn it by passing the super strict Predominance Test. To qualify, their gross income from unrelated trade, business, or other activities absolutely must not exceed 50% of their total gross income from all sources. The BIR basically wants to make sure a hospital is actually acting mostly like a hospital and not just acting as a front for some massive commercial real estate business. I want you to visualize this 50% threshold as a really precarious tightrope. They have to balance their revenues perfectly. If their unrelated commercial activities get too heavy and tip the scale past half their total income, they fall right off. So think fast, active recall time again. If a hospital's unrelated business income hits 51%, what happens to their tax rate? Connect this back to what we just discussed. Exactly. They fail the predominance test and lose the perk entirely. They get slammed with the regular corporate income tax, or RCIT, of 20% or 25%. And here's the kicker, it's not just on that unrelated income, it's on their entire taxable income. That is a brutal penalty, guys, and it's an absolute favorite trap for board examiners to set for you. All right, shifting gears to drawer 4, tax-exempt educational institutions. We're moving to a completely different tier of schools now. Notice how this builds a really strong contrast. The proprietary educational institutions, the PEIs we just talked about, they just get a discount, right? The 10% or 1% if they pass the test. But non-stock, non-profit educational institutions, NSNPEIs, they get a total free pass, a full tax exemption on revenues. Why? Because they have no stockholders and no one is making a private profit. So the 1987 Constitution itself literally shields their revenues and assets from taxes. But to keep that constitutional free pass, you absolutely must memorize the ADE rule. The revenues and assets must be used actually, directly, and exclusively for educational purposes. Otherwise, the exemption vanishes. Like, if a nonprofit school takes its tuition revenues and buys a luxury yacht for the university president, yeah, no way. That money is immediately taxable. It has to be ADE, actually, directly, exclusively for education. Okay, home stretch. Opening our final drawer, drawer 5, statutory exemptions and BMBs. Let's do a rapid-fire breakdown. I need you to take a mental snapshot of these 5 organizations right now, because these statutory corporations are absolute mainstays in the multiple choice questions. We've got the GSIS, SSS, PhilHealth, PUGABIG, and local water districts, or LWDs. If you see these options on the exam, you need to instantly know they are exempt from corporate income tax by statute. Lock it in. Additionally, we have our BMBEs, the Barangay Micro Business Enterprises. These are designed to help small, grassroots businesses thrive, so they are entirely exempt from income tax on income arising from the operations of the enterprise. But wait, what actually makes a business a BMB? There's a specific test. The magic number you need to know is 3 million pesos. To qualify, they need a total asset threshold of not more than 3 million pesos, but strictly excluding the value of the land. So say their total assets are 3.5 million, but the land the business sits on is worth 1 million. You subtract the land, their qualifying assets are only 2.5 million, which means they pass the test and get that sweet income tax exemption. Okay, before we wrap this explainer up, let's test your analytical skills with a classic LECPA trap. We just listed a bunch of exempt organizations, right? So here is the trick question. Are the incomes from real properties owned by these exempt organizations also automatically tax-free? Think about a hospital renting out commercial space. The answer is a hard no. The rule states that income of whatever kind and character from their properties shall be taxable, regardless of how they use that income. The only brilliant exception to this are NSNPEIs, but only if they followed the ADE rule we talked about. So income from for-profit activities for the rest of them is fully taxable. It just goes to show that in taxation, the general rule always hides a brilliant exception. Keep these mental drawers neatly organized and you are going to absolutely dominate the LECPA. But I'll leave you with this thought to chew on. If nonprofits are taxed on their commercial rent, just like regular massive corporations, is the government truly leveling the playing field, or are they quietly punishing good deeds? Think about it. See you next time and keep questioning the code.